Last week's thumbnail said it would be the most mind-blowing week of 2023 so far, and it sure turned out to be. We all expected that the economic data plus Fed meeting would produce fireworks. However, the volume of post-meeting crosstalk, doublespeak, and confusion ruled the rest of the week. Here is what happened. On Wednesday, after a two-day meeting, the Federal Reserve decided to leave interest rates unchanged and stated, holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. This wasn't entirely surprising one way or another because the consensus coming into the meeting was a pause and rate hike over the course of the next two meetings, not really caring which decision happened at which of the next two meetings. The surprising aspect of the decision came with the dot plot chart in which the individual members of the Fed indicate their expectations for rates further out. The dots moved upward, pushing the median expectation of a Fed funds rate to 5.6% by the end of 2023. That's a range of 5.5 to 5.75. Simply translated, the Fed needs to increase the rate by 50 basis points or 0.5% between now and the end of the year. We have 4 meetings left and likely 2 quarter-point increases sometime across the remaining meetings. First of all, this is higher than their previously stated terminal rate and an admission that there's still more work to do. Inflation is kicking their butt, and even slowing inflation data still isn't enough to give them confidence that rate hikes are over. So now we're left asking, if they know we need a higher Fed funds rate, why don't they just jump to that right now? The answer is timing. They want more time to see how much progress can be made with their actions up to this point versus continuing to add even more pressure to the system and potentially go too far, too fast. This is because of data lags where the measured impact of rate hikes since March 22 are now only beginning to show their weight on outcomes. It's all about timing. And I want you to remember that for the rest of this episode. Timing will be everything for the remainder of 2023 and into 2024 and 2025 when it comes to interest rates, consumer finance, real estate, mortgage rates, absolutely everything. And as for mortgage rates, they're gonna go up, but probably slowly over time. Remember the crosstalk, doublespeak, and confusion I mentioned at the top of the show? It's throwing a wrench in the analysis left and right, and that's affecting mortgage rates. When you have analysts saying that this pause could signal an end to the Fed rate hikes, where's that even coming from? That's not what Jerome said. That's not what the chart future rate expectation shows. So are they just saying this to affect the market input they want to see? It's almost like they're trying to buy themselves more time to sort out what should happen versus what is most likely to happen. The mortgage market has a newfound appetite for rates in their current range of the 6s plus or minus 0.25%. With more general economic uncertainty on the horizon, plus future Fed rate hikes, there's a lot of uncertainty in mortgage rate land. And here's a quick look at what we're watching in the markets this week. Monday, banks are closed. Tuesday, building permits and housing starts come out, which are both important to the mortgage industry when it comes to inventory, sentiment, and home prices. Wednesday, Fed Chairman Jerome Powell testifies before the House Financial Services Committee. It's unlikely there will be any commentary that deviates from last week's announcement and press conference. Thursday, unemployment claims comes out, and Jerome Powell gives his second day of testimony. Finally, on Friday, flash manufacturing PMI and flash services PMI both come out. And that's it for this week. Remember to like this video, subscribe to the channel, and turn on notifications so you catch every episode right when it releases.